Welcome to the Capital News. I am your host, Alex Kreitis. Today is Thursday, May 13th, 2021. Thank you so much for joining me. The title of today's podcast, Jobless Claims Down, Producer Prices Up. So yesterday we received the report out of the Bureau of Labor Statistics, the BLS, on the Consumer Price Index. Today they released the Producer Price Index with figures that are also worse than market expectations. A couple of figures making records on a year-over-year basis since records have been kept. We'll get to that report momentarily, and as we did yesterday, we're not going to go through it in its entirety, but we will read some of the major talking points on that report. And the reason I don't go into great depth with the CPI or the PPI report is because, like so many other statistics, I really think they're bogus for the most part. I don't like how they're calculated, but this is the information that we're given, so we're going to work with it, obviously, but I just don't want to get too bogged down into some of these details. Now, with respect to the jobs report, I like to go deeper into it because there are some of those more structural data points that do exist within the jobs report. However, most of the time, especially on the mainstream media, those structural figures are usually thrown to the side unless it's something that fits the narrative. So that's why I go into greater detail into the jobs report, even though I have a lot of issues with that. But with the PPI and the CPI report, I'm going to give you the headline. I'm going to go into a little bit of the detail, but we're not going to read those reports in their entirety. If you want to find them, you can easily find them on bls.gov, bls.gov, and you can read them in their entirety if you so choose. So we're going to get to market performance, the initial jobless claims report that came out today, and an update to the Federal Reserve's balance sheet, which, well, Nelly, surprise, surprise, has hit a new all-time high. We'll get to those figures here momentarily as well. But a brief update to a couple of points that we've been talking about this week. One is the Israeli and Palestinian conflict continues to intensify, unfortunately, despite an international attempt to bring the parties together for at least some sort of discussion to achieve a ceasefire, even if temporary. That does not appear to be the case, that's likely to happen right now. And we have some Israeli politicians actually more concerned about the clashes that are taking place in the streets between Jews and Arabs inside of Israel. They're more concerned about that than they are going to war between Israel and the Palestinians. You see, folks, this is why I harp on these protests and these riots, because this is serious business. As far as I'm concerned, these Israeli politicians, they get it. They understand how dangerous these types of protests and riots and fights between people within their countries can be, and they are. So this can spiral out of control, and it can do so very quickly. Of course, we don't want to see those types of riots, and we don't want to see any type of war breaking out either. But we can't be surprised, because there is so much dry tinder all over the place, and it just takes the smallest of sparks. And I don't think a lot of the equity markets in particular have priced in all of this risk. I just don't think they are. I think they're just in la-la land. Don't worry about it. If something happens, federal government will do something. If something happens, a central bank here or another one over there, or in a coordinated effort, will get together and they'll do something. So we don't have to worry about war. We don't have to worry about an asteroid coming down. If that happens, I mean, stocks would go all-time highs. Because, oh my goodness, could you imagine the wreckage, the extinction? But don't worry about it, because Uncle Sam will flip the bill and J. Powell and Company at the Fed will print more money. So we don't have to worry about it. That's, you have to understand this. This is the world we live in. This is insanity. But this is what we deal with on a daily basis. And talking about insanity, we spoke yesterday how Elon Musk, the CEO of Tesla, came out and did a 180 on his Bitcoin play. Earlier this year, he announced that Tesla was going to be purchasing a substantial amount of Bitcoin. I believe it was about $1.3, $1.5 billion worth of Bitcoin to put on the books on Tesla. And just yesterday, Mr. Musk comes out and says, yeah, we're no longer going to accept Bitcoin for purchase of our vehicles. We're just not going to do it because the reasoning, which we didn't get into yesterday because there was other things I wanted to discuss, but the reasoning behind all of this is, well, Tesla is supposed to be this quote-unquote green company, and the amount of energy that Bitcoin uses in its mining operations, and in its transactional purposes, is through the roof. I mean, it literally dwarfs some countries' energy usage. Okay, and there's not that much adoption of it. Again, another reason why it's bogus, but okay. So these things were conflicting right out of the gate, that a green company, quote unquote, such as Tesla, was going to be involved with a cryptocurrency that just sucks up so much energy. And from what we understand, most of these mining operations actually take place in China. So you have the human rights issues, for one, which a lot of companies don't necessarily want to associate themselves with those issues, but they always have a blind eye when it comes to China. But then you also have to look at China with all of the coal power plants that they have all over the country. It is coal, this dirty, dirty, dirty source of energy, they tell us, that would be a major contributor to the energy source for these mining operations. But that didn't appear on Elon Musk's radar before. But now all of a sudden he gets it. How could this guy not understand that a few months ago? Or did he perfectly well understand it, and he was just more interested in getting the attention, being the center of attention, and that's all he was going for. He wanted to manipulate the market. He wanted to see what he could get away with. He wants to taunt the SEC and any other type of regulatory agency. Is that all he's trying to do and get away with? Again, I think the guy needs to be investigated. I'm sick and tired of him coming out with these comments and these market manipulations, because that's what they are on their face. You and I did this. They're going to lock us up and throw away the key. If this guy wants to talk about electric vehicles, putting chimpanzees and human beings on Mars, let him talk till he's blue in the face. But when it comes to this type of stuff, I'm really getting troubled by it, and it's bothering me. I don't like it. So is he going to stop operations in China because of how dirty they are over there, their air quality, their energy practices? I mean, Tesla's building a gigafactory over in Germany. They just leveled a forest. How is that green? Or are trees a problem now too? I mean, this is what happens when you live in la la land. There is no logic. And then you have some people who are called on to, I believe it was CNBC this morning, to give a response to this news from Elon Musk. And they were bringing on some major proponents and supporters of Bitcoin. And of course, when it comes to Bitcoin, there's no such thing as bad news. But of course, a lot of these Bitcoin bros, they cannot stand Elon Musk now. That's how quick they turn on people. It's a cult. That's how sick this is, okay? So when Elon Musk came out a few months ago and put this on Tesla's books, it was the best thing since sliced bread. See, we told you that Bitcoin's the best thing. There's adoption and blah, 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 blah. Now he does a 180. Now he's the devil. But according to this one supporter and proponent of Bitcoin, this still isn't bad news. In fact, he wants to spin it as being good news and was citing the Streisand effect, which basically states, well, just because it's mentioned, because it's getting attention in the media, people are paying attention to it now, and because they hear it, they're going to go out and buy it, which of course is ridiculous. It's nonsense. But these are the arguments these idiots have to come up with, okay, which just tells you what a piece of junk this is to begin with, all right? I mean, if Elon Musk came out and said, hey, I got a bag full of crap over here, because he mentioned it and because the media picks up on it, does that mean that that bag of crap has value and everybody should go buy it? No, of course not. But it's on TV, so I guess people are going to fall for some of this stuff. Well, shame on you, and you're going to get what you deserve, I guess. Because you see these massive drops in the price of Bitcoin and other cryptocurrencies as well. But hey, it's your money, it's your risk, do what you want. I think there are better places to put your cash, but that's just me. So that's just more insanity for these markets that are greatly manipulated. And as I stated yesterday, is it really a marketplace when one individual or a couple individuals with a lot of influence can come out and move markets like this to this degree? It's something you have to answer for yourself. Some market performance, we have corn hitting a near 8-year high at $7.70 per bushel for the first time since July of 2013. But there's no inflation. Oh, but there is. Mexico's central bank holds their interest rates at 4% as widely anticipated. The dollar index is at 90.71, not too much movement overnight in the Forex markets. We have Bitcoin slightly down, below 50,000 a coin at $49,500 per coin. So well off its all-time highs. Thank you, Elon Musk, right? Overnight futures market trading, we have the Dow Jones up about 1/3%. The S&P 500 is up about 0.4%. The NASDAQ 100 is up about 0.5%. The major averages in the day session were all up, rebounding from the recent sell-off. Cash trade in Japan is also strongly up in the green right now, up 2.25%. A mixed bag across the pond in Europe today. Nothing major to the downside, nothing major to the upside to report either. A little bit of a rebound in the cash trade in Australia, putting on a gain of about 0.7%. Chinese stocks up 1.2%. Indian stocks up 0.1%. Commodities pulling back a little bit. We got WTI at $63.63. Brent $66.77. Natural gas $2.70. Gasoline pulling back also $2.09. Gold and silver also in the red. Gold at $1,823 an ounce, silver at $26.94, but still hanging on right around that 27 handle. Again, I want to see it break above 28 and hold. If it can break and hold above 28, I think we got a lot of room to run to the upside. Gold, I want to see another about $25 to $30 on a technical standpoint, and we're going to have some room to run to the upside as well. But they are slowly and steadily taking out some resistance on from a technical chart standpoint. Copper also down a little bit at $4.66 a pound. Lumber continues its climb at $1,630 per 1,000 linear board feet. And Uncle Sam's 10-year junk note is at 1.65%, relatively unchanged from yesterday. So let's see where we want to go first. Let's go into the initial jobless claims report first. So the headline figure comes across at 473,000 for the week ending May 8th. That is the seasonally adjusted figure. On a non-seasonally adjusted basis, it comes in at 487,000. The prior week's figure was revised upward by 9,000 and now stands at 507,000. Okay, so it's good to have that number at 473,000. That's what we want to see. Finally starting to get below that GFC level was the first time we saw that last week. Again, that's taking in the aggregate figure of the state unemployment benefits. So your traditional unemployment benefits, that's the headline figure. So that's that 473,000 figure. But we also have to take into consideration the pandemic unemployment assistance figure because that was created. That was one of the children of the Nobody Cares Act 1.0. So that allows people who would typically not qualify for regular state unemployment benefits to have an avenue to receive some support. So we have to take those numbers into consideration. We have to add them up. The PUA figure for the week ending May 8th came in at 103,000, almost 104,000. So even combined, we're still below that number, the worst number we saw during the depths of the great financial crisis. So that is something we want to continue to see. So that is at least some good news. And we're going to monitor this closely. We're going to continue to pay attention to this on a week-by-week basis because I don't know how strong and long-lived this is going to be, unfortunately, because all of the funny money, it is going to wear off. There's no ifs, ands, or buts about it, but it is in the system. It's making its way through the system. We're seeing that in the inflation. We're seeing that in so many other issues, and a lot of that is just getting started. When it comes to continuing claims for the week ending May 1st, this lags a week. On a seasonally adjusted basis, we're at 3.7 million, and on a non-seasonally adjusted basis, we are also at 3.7 million. Grand total, when we take everything into consideration, that's regular state, federal employees, newly discharged veterans, the PUA and PEUC programs, extended benefits, state additional benefits, and work share, we get a grand total of 16.9 million. This is for the week ending April 24. This is a week-over-week increase of about 700,000. So that aggregate number is in the wrong direction. But again, this lags a couple of weeks, but nonetheless, this is what we have been seeing. These big swings of several hundred thousand, even a million here or there in recent months. So again, the grand total is 16.9 million. The biggest increases came in the PUA and PEUC programs. With PUA, it was up 420,000. With PEUC, it was up 291,000. That gives us a de facto unemployment rate of about 12.8%, which is well above twice the official jobs report that came out last Friday. So that is twice the official unemployment rate, which is currently at 6.1%. Recall, market analysts and expectations were for a much stronger jobs report, close to 1 million jobs, perhaps, maybe even more, and we got 266,000. Okay, that's the official number. They were also anticipating an unemployment rate closer to about 5.4%, maybe even less than that by some analysts. We're now at 6.1%, slightly up where it was prior. It was about 6% there before. So we're double that. It's interesting to see where the Federal Reserve would come out and claim as to whether or not they believe that number, or are they sticking with their 10%? Right? That was news. As far as I was concerned, that was breaking news a few months ago when Jay Powell came out and said, yeah, unemployment at 6.3%, which is what it was a few months ago. Yeah, that's the official number, but we think it's closer to 10%. And we said you have to pay attention to that because it's a shift in the narrative. Rarely, if ever, do you have somebody from the Federal Reserve contradicting or questioning an official government statistic. Now, the Federal Reserve doesn't calculate this number. That comes out of the BLS, Bureau of Labor Statistics, as does the CPI and some other data, which, again, is why I've always been asking the question, if we can't trust the BLS to calculate the unemployment rate appropriately, then how can we trust them to calculate the CPI and the PPI appropriately? And, of course, that's what I said at the top of the podcast. I don't put a lot of weight into those reports, but we do watch them for trend analysis purposes and just to see what they come up with. But one of the reasons that the Federal Reserve questioned these official government stats is because it didn't go with the narrative. Just like I said with the jobs report that came out last Friday, I said, well, look at this thing, right? I mean, this fits their narrative. That's what they wanted to see. They didn't want to see 1 million jobs created, quote unquote created. That hurts them. That puts them into an even smaller box than they're already in, an even tighter corner than they're already in. Because if everything is rebounding, if all the data is looking fantastic, then what's the justification for more quantitative easing? What's the justification to keep interest rates lower for longer? What's the justification for Democrats in the White House to push for more fiscal policy? It just shoots that narrative in the rear end. But with 266,000 jobs being reported and the unemployment rate actually going up, oh my, now they can justify quantitative easing. Now they can justify lower interest rates for longer. Now the Democrats in the White House can justify more fiscal policy. You see how this works? It's a joke. It's a big game. That's how it works. And we have to pay the bill in more ways than one. We got to pay it in direct taxes, which will be going up at the federal level, at the state level, at the local level. Just think about it. Look at all of these real estate prices going up. You think your towns and cities and boroughs, do you think they're not going to do a reassessment of these properties? Your taxes are going up, pal. What don't you get? We cannot run trillion-dollar deficits and not have your taxes go up. It's just that simple. I've been talking about this before the pandemic and before Nobody Cares Act 1.0, 2.0, and 3.0. There is no free lunch. Get that in your head. And as we discussed yesterday with the CPI, a lot of those funny money checks that you got went straight out the door to go buy a house, to go buy a car, whatever the case may be, because that's how quickly those prices have gone up. And you thought it was a gift. You thought the Democrats and the Republicans were your buddies. No way, no how. This is as plain as day. It's right in front of us. You just have to pay attention and you have to put the BS out of your head. How do you know it's BS? Because it's most likely it's 99% of the people who are talking to you on MSNBC, CNN, and Fox. Okay? That's why you got to turn them off from time to time, and you have to think independently. If you're not thinking independently, then I don't know what to tell you. I mean, you better start meditating, you better start reading, you better start turning those news channels off, because it's really affecting you. Believe me when I tell you. You need to snap out of it. And you need to listen to podcasts like this and a handful of others that are out there that at least question this stuff. And you don't have to agree with everything that I'm saying. That's perfectly fine. I don't expect everybody or anybody to agree with me on everything that I say. But at least question this stuff. Don't just follow it blindly and just regurgitate what you hear and treat it as gospel truth. Because most of it just simply is not. So a lot to get to, right? So much to get to. So that number, again, 12.8% is the de facto unemployment rate. The government is trapped. The Federal Reserve is trapped. They're running out of time. As far as I'm concerned, we're starting to see some of these markets, and I really think gold and silver smell a rat, that rat being inflation. It's here to stay for a while. It's structural. I think it's going to be impactful for probably the remainder of this decade, definitely the next handful of years for sure. And if we continue to see more pressure on prices, you're going to see these protests and riots intensifying. And you're also likely going to see a lot of strikes take place too as a result, because if you continue to see a lot of increases in commodity prices, and these miners, so to speak, right, they're going out and they're digging this stuff out of the earth. If their wages aren't increasing, but they notice and they understand that the price of the commodity keeps going up, but all of the other costs might not be going up with it. In fact, some of the operational costs may have gone down from a financing standpoint because these corporations may have rolled over their debt at lower interest rates. So now their borrowing costs are even lower than what they were before. So now these workers are going to get together and say, hey, prices are up, they're through the roof, but my wages aren't going up. I want a bigger piece of the pie. You see what's going to happen here? A lot of this is not even being discussed. And you still got a bunch of people out there talking about deflation. Again, please, don't insult us with this nonsense. This is an academic argument. All of these people around the world are not protesting and rioting and demanding change because the cost of living is so damn affordable. It's that simple. It really is that simple. And what else is simple is to look at those monetary measures. To look at what one central bank after the next has been doing, especially the major ones. The ECB, the Bank of Japan, People's Bank of China, Bank of England, Royal Reserve Bank of Australia, and the Federal Reserve. Straight up charts. Straight up vertical charts. I meant to say. Vertical. You don't just get to unwind that. That is going to do irreparable damage, and we're going to be paying for it for a long time to come. Producer Price Index. All right, for April 2021. The Producer Price Index for final demand increased 0.6% in April on a seasonally adjusted basis, according to the BLS. Final demand prices rose by 1% even in March and 0.5% in the month of February. On an unadjusted basis, the final demand index moved up by 6.2% for the 12 months ended in April. This is the largest advance since 12-month data were first calculated in November of 2010. So again, the final demand index moved up 6.2% for the month of April. The largest increase since 2010, since records have been kept. About two-thirds of the April advance in the final demand index can be traced to a 0.6% increase in prices for final demand services. The index for final demand goods also moved up 0.6%. The index for final demand, less foods, energy, and trade services rose 0.7% in April, following an increase of 0.6% in March. For the 12 months ended in April, prices for final demand, less foods, energy, and trade services moved up 4.6%, the largest advance since 12-month data were first calculated in August of 2014. So there you have it, a couple record breakers on those year-over-year figures. Everything and then minus the demand for food, energy, and trade. 6.2% and 4.6% respectively. But hey, there's no inflation. You don't have to worry about anything. It's all because of base effects, and you don't have to worry about anything anymore after that. After that, it's just going to be peaches and cream. All of your prices beforehand, completely tolerable, which of course to many people, they were not. They were not. And I have to go back and bring a political argument back into the fold, which I've mentioned many times before. So for those of you who make the argument that for the past 12 years, or since the inception of quantitative easing, that there hasn't been any type of inflation in this country, that's ridiculous. It's ridiculous. People cannot afford to live. If everything was great and the cost of living was so damn affordable, Donald Trump never would have become president of the United States. He wouldn't have had a prayer. As flawed a candidate and a person that Hillary Clinton was and is, she still would have won. Because if everything was great, the system ain't broke, why fix it? Donald Trump was viewed by many as a wrecking ball because we were sick and tired of the status quo. So yeah, this guy might be a little off here or there. We might not like how he talks, but you know what? We cannot continue anymore with this status quo. So clearly the status quo was not working for a significant portion of this country, which it's not. So you give the guy a chance. But if everything was so great under the status quo, under the Obama administration for 8 years, under the Federal Reserve's policy of quantitative easing, well, then they would have continued to vote for it. If it was so great, why would you stop it? These are very logical questions to ask and very easy to answer, too, as far as I'm concerned. So that's just another point. People want to make believe that there was no inflation over the past several years. There's been a ton of inflation. Again, in those things that people need to live. If they want to bring in a whole bunch of other goods and services that people really don't need, it's discretionary income. It's something to be hip to keep up with the Joneses. I couldn't care less about that garbage. I care about the stuff that you need to live. Period. End of story. Because as crazy as I think things are going to get, that's all that's going to matter. And those prices for those goods and services are going to continue higher. It doesn't mean it's going to be straight up. There's going to be some volatility. There's going to be some ups and downs. But the general trajectory is up, and away. And people are not going to like it. And once we start to see food prices, especially food prices, continue to increase because revolutions are fought on empty stomachs, that's when all hell is going to break loose. We saw this in the Arab Spring a decade ago, and those are the reference points that we are mentioning here. One commodity after the next, especially in the agricultural space. We are seeing prices now at levels as to where they were during 2010, 2011, 2012, which was the birth of the Arab Spring. Because they were tired of the inflation. They were tired of the higher food prices. They were tired of the wealth inequality. And that was a couple years after quantitative easing started. Because there's a lag to monetary policy, folks. It's not flipping a switch. And those effects are broad-based. You might feel them very quickly in some aspects, like the financial markets. You can start to see big increases very quickly with those liquidity injections, but to make it throughout the broader economy takes some time. Well, guess what? We started this crap a year ago. And it's at a multiple of what we did during the great financial crisis with respect to quantitative easing. So if you thought that damage a decade ago was bad, just wait till we see what comes now. Again, these are logical questions to ask and answer. And then you add on top of the monetary madness, you have to bring the fiscal fiasco into it as well. And what we've done now and continue to do totally dwarfs by an order of magnitude what we did during the great financial crisis. I mean, this isn't even close. I mean, we were in the billions, hundreds of billions back then. Now we're in the trillions, multi-trillions. That by itself tells you that this has been inflationary. Because $700 billion doesn't buy you what it used to. $700 billion presumably could solve, and I'm picking that number because that was the TARP figure, the Troubled Asset Relief Program figure. Presumably that was big enough to save the financial industry back then. Of course it wasn't because of all the monetary stuff, but you get what I'm saying. Now we need trillions. And it's still not enough. Oh, but there was no inflation. Just don't believe those people. I mean, think what you want. Again, think independently. I don't want to do your thinking for you. But I think I'm making a pretty solid argument here. based off of common sense, based off of reality. Not some academic BS that somebody wants to live off of reality, how it affects real people. To me, that's what matters. To me, that's what's important, because that is the intersection of economics, politics, and society. You got to look at all of those things together, not in isolation, because you're going to miss the boat. And there's too much to pay attention to in all of this. Now to round it out with the Federal Reserve's balance sheet, and I will let you go. An all-time high at $7.83 trillion. $7.83 trillion, a week-over-week increase of $20 billion. Chump change, $20 billion. Again, the Federal Reserve remains committed, at least for the time being, and of course I imagine this will be for till the end of the year, if not further, of their quantitative easing program, $120 billion per month at minimum to purchase U.S. Treasuries and mortgage-backed securities. About $40 billion of mortgage-backed securities per month, even though housing prices are at all-time highs and continue their upward climb. So there you have it. The interesting observation to note this week, however, is the sell-off that we are witnessing on Wall Street and within global equity markets, yet we have the Federal Reserve's balance sheet making a new all-time high. So again, this is the big narrative as far as I'm concerned, because what we've been witnessing is a very close and tight relationship between these liquidity injections and the trajectory of global equities, especially U.S. equities. New all-time high, yet we have stocks selling off. So is this a breaking point? I'm not saying that it is, but this is what you're going to see as far as I'm concerned. This is the argument that I've been making here for quite a while. This is the only one that matters. It's not organic growth. It's not productivity increases, because this stuff doesn't exist virtually, unfortunately. It's all about liquidity. It's all about interest rates. It's not about out-competing, offering better services here or there. It's about interest rates. It's about monetary and fiscal policy. This is a centrally controlled economy, which is exactly what we should not have, but we do. So the argument that I've been making, along with others, is the liquidity. It's all about that. If equities want to continue to believe in these liquidity injections, then they'll continue higher. But when they no longer believe it, it's game over, because there's nothing else that these people can do. This was the only trick they had up their sleeve. So this is a break that we're seeing this week. One break does not mean it's a change in trend, but it is a data point that we're going to monitor here closely. So jobless claims down, producer prices up. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Kreitis. Godspeed.